Your adult child hands you $400 a month for rent. Do you owe taxes on that? The IRS says it depends. With multi-generational living on the rise, more American families are navigating this exact question. Get it wrong and you could face unexpected tax bills, 20% underpayment penalties, or missed deductions you actually deserve. The tricky part is the IRS doesn't have one simple rule. It depends on how much you charge and how you document it. Here's what matters. The IRS looks at whether you charge fair market rent or something substantially below it. If your child pays $400 a month for a room that would rent for $1,200 on the open market, the IRS classifies that as personal use under IRC Section 280A. You still report the income, but you can't deduct most rental expenses. If you charge fair market rent with a real lease, you get access to deductions like depreciation, repairs, and insurance on Schedule E. There's another wrinkle. If the gap between fair market rent and what you charge is large enough, the IRS could treat that discount as a gift. If the implied gift exceeds the annual exclusion amount, you may need to file Form 709. This is general information, not financial or legal advice. Rent-free use of a separate property you own almost always triggers this analysis. Most parents do best by keeping below-market contributions informal and proportional to shared household expenses and simply not claiming rental deductions. If you want to run a legitimate rental charge, fair market rent, use a written lease, and keep separate accounting records. Either way, put it in writing. A written agreement is your single strongest piece of evidence if the IRS ever asks questions. Chipkie helps families create clear, documented financial agreements, from rent arrangements to personal loans, so nothing catches you off guard at tax time. Set yours up in minutes at chipkie.com.